Today, we're talking about an often overlooked corner of real estate investing that's quietly having a moment: note investing. I'm Kathy Fettke, and welcome to The Real Wealth Show.
You're listening to The Real Wealth Show with Kathy Fettke, the real estate investor's resource.
My guest today, Eddie Speed, is one of the most experienced note investors in the country, with more than 4 decades in the business and tens of thousands of notes under his belt. Eddie has seen every cycle, every boom, and every bust. And he says right now may be one of the best environments he's ever seen for being the bank instead of the landlord. And if you've ever wondered how note investing really works, who it's right for, and why experienced investors are paying closer attention to it in this cycle, you're going to get a lot out of this episode. If you want to learn more about this conversation, visit noteschool.com/real wealth. Eddie, welcome back to The Real Wealth Show.
Thank you. I'm so glad to be here.
It's nice to see you again. I've known you for, I think I can say a couple decades now, maybe
I
3.
think that's probably true. Yes.
Oh boy. All right. So we have a lot of experience we can share, but let's start with, right before the show, you said you've, something to the effect of you've been to a lot of rodeos, and this one, you're in the front seat. So what do you mean by that?
Well, I think the market has certainly cycles to it. There are times that it's not always profitable to do exactly the same thing. I've been in the note space, basically owning mortgages on people's property. I've been in the note space for 45 years. Well, it's not been all the same for 45 years. Sometimes it's way better than others. Sometimes the apartment syndication world is really good. Sometimes the apartment syndication world isn't so good, right?
Yeah.
So there's cycles to every business. And I think we've sort of rolled around in the market to where we're in a good cycle for, buying notes, owning mortgages on properties, and, the rate of return we can earn is very good. The risk, I think, is low. I know it's low. And so we're in a good side of the cycle. And a lot of people say,
before I
"This
get
isn't about
into
being the bank, Eddie." Yeah.
So before we get into exactly why right now is a good time to be in
Yeah.
the note investing business and why it's, I think you said safe, although we're not really supposed to say that in investing, because nothing is technically safe. There's always risk to every investment. However, with that said, when was it a really bad time to be a note investor?
2021.
Really? I thought you were going to say 2009.
No, 2009, we killed it.
Oh,
I mean, we were buying defaulted loans at 20 cents on the dollar.
okay.
And then people were seller financing properties because they were creating performing notes, and then there was non-performing notes. So we rocked it out after 2000.
Because you were buying notes at a discount. But okay, so then if you were somebody having to discount their note, it depends on which side you were on. I guess if you bought a note in 2006, 2009 wasn't a good year for you.
We're pretty much a contrarian business.
Mm-hmm.
We tend to do good when the banks and mortgage companies aren't doing as good. That's kind of a pattern.
Okay. All right. So why was 2021 not a good time?
Well, 2021, interest rates were crazy low,
Yes.
right? Loan production for the residential loan origination business originated about $4.5 trillion in volume that year. Now,
Wow.
you want to know how much they've originated this year?
Yes.
About 420 billion.
Oh my goodness. Wow.
So you're saying, Eddie, are you saying that the loan origination business for residential mortgages, the production is off 90%? And the answer is yes, I am.
Oh my goodness. Okay.
So we tend to do good when these other businesses don't do so good.
Okay, so let's talk about exactly what it is you do, because there's a lot of different ways to be a note investor and to be a lender.
Yeah.
You can buy notes at a discount. You can be the original, just do a note for a fix and flip, or for your kid. Maybe you want your kid to get their first home, and you give them money, and you secure that money as a loan on the property, and you make interest, and your hopefully your note is secured. But what is your niche?
So my niche is primarily buying seller financed notes. I've bought other loans, so it's not that I exclusively do that, but I bought 50,000 seller finance notes. So it's kind of my thing, right?
It's so
And
funny because it makes me go, There's that many seller finance notes? That's incredible.
yeah,
Who's doing all these loans?"
well, they create about 100,000 seller finance notes a year. So the industry last year was about a $30 billion business. So it's a little bigger than people think it is.
Because it's
And
somebody selling their home or their property, but they're just going to not
there,
really sell it. Oh, they're selling it, but keep holding back the note.
there's two kinds of people that create seller financing. The first type is what we call a mom and pop. So they
Mhm.
have one property. The realtor or their next door neighbor or somebody says, "Why don't you sell the property and be the bank?" In other words, don't sell it for cash, sell it, get a down payment, and finance the buyer over time with interest, right?
Yeah.
And so that's just a mom and pop that creates one note their whole life. They'll never do it again. The odds are very low they'd ever do it twice.
Mhm.
The other seller is somebody that creates notes on a recurring basis. And we would say that's a professional real estate investor who originates seller financing as a business model. And that's really my customer. My customer is somebody that does this over and over. And so I don't necessarily buy the mom and pop notes anymore. You've known me, Kathy, when I did,
Mhm.
but it's just too hard to scale it. And
Mhm. Yeah.
my largest customer created $50 million in seller finance notes last year.
Oh my goodness. So all you need is one or two of those. And so this is as a professional seller financer, you would find a property, fix it up, increase the value, and then sell that property to a homeowner who's
That's it.
basically kind of a renter. I mean, how are they structuring it in
And
order to do this over and over again?
yeah, so they're structuring the note. They probably get 10 to 15% down. They're selling to people with good credit. They're selling people with verifiable income. So they're really originating a loan like a bank would, not a Fannie Mae loan. But Fannie Mae's underwriting is crazy tight. Like, if you looked at Fannie Mae's underwriting the day that the COVID virus started, it was at the underwriting meter was about at 185. That's a matrix that Mortgage Bankers has developed, right?
Hmm.
Today that they're at about 100. So the underwriting standards for Fannie Mae loans is twice as tight as it was. So meaning that if 1,000 people could have gotten a loan, now about 500 could get a loan. So they've left it open for people to do what I think is common sense lending
Hmm.
because they're not serving that market that well.
So that's why you're saying now is a good time because it's so hard for a homeowner to get a regular loan. They would go to an investor and be able to get it that way. So will you walk me through like one of your clients' typical deals where they're buying, how much they're paying, how much they're renovating, what they're selling it for, what the interest rate is, and then why you come and swoop it up? Why don't they keep it? So that was a lot. That was like 5 questions in one question, but
No worries.
let's hear it.
So there's about 20 states, 18 or 20 states that are the most common. Texas is the most common to seller finance. My largest clients, actually, believe it or not, primarily they work in about 8 different states, but I bought more notes from them in Indiana than any other market.
Mm.
And while I'm a Texas guy and I love Texas, to be honest with you, the economy is better in Indianapolis right now than for houses than it is in Dallas.
Why is that?
Just houses have not declined in value in Indianapolis than they have in Dallas.
I see. Okay.
And so a lot of the big Texas markets, have been good, but they have, I'm not saying a crash or 2008. I'm not saying anything like that, but I'm just saying, so they find a working class person. And I'm going to kind of pick on a group here for a minute, okay, just so you get a sense of how this works. But my biggest client targets Hispanics. Okay. They buy a house. It's in good repair. So they fix it up. It's not junky. It's not tore up. It's not in bad neighborhoods. And they sell it to a Hispanic that's legally here, that has verifiable income, has good credit. So this is not like, ICE is going to come pick them up and take them out of the country here in the next week. It's not that. But the Hispanic lending market has grown in the last 3 years, whereas the traditional lending market, of course, has plummeted.
Aren't they one of the fastest growing home
A
buyer
hundred
groups?
percent, a
Yeah.
hundred percent. And so, but they can't get a Fannie Mae loan. They can't, if they have a green card, even though they're legal, they can no longer get an FHA loan,
So
right?
there's really no other options.
Underserved market.
So here legally, but with a green card.
Yes.
And you cannot get traditional financing with, oh, okay.
And Kathy, I understand this customer really, really well. You know that, like from way back, from
Yeah.
decades back. And so we feel like we're providing home ownership for them, right?
Hmm.
We're helping them with financing. The financing is not cheap, but that's just what the market is. Non-QM loans, non-qualified mortgage loans today, the rates are anywhere from 9.5% to about 10.5%. That's just what
Oh
they
my
are.
goodness, because they're not backed by the US government.
It's a market condition.
Hmm.
40% of the origination market today are non-QM loans, non-qualified mortgages. So just because they don't qualify for Fannie Mae doesn't make them bad, but that's a market condition. Now, my customer, Kathy, they originate all these loans, and guess what? If they don't sell some of these loans, they run out of money,
Right.
right? So I'm part of a marketplace. And then so now there's all kind of ways to do it, and we won't get too down in the weeds on it, but they can trade and sell me all of their loan, or they can trade and sell me part of their loan.
I know I've taken your courses and you have to kind of understand math. But it's,
Well,
boy, this is why you call it the like hidden or shadow real estate market because it's fancy, but boy, is it profitable.
yeah, and so I might come in and at their payments $2,000 a month. I might buy $1,200 of their payment, and they keep $800 of their payment. And there's ways that you can do different ways in structuring it, depending on what the situation is. But we've got decades of experience with this customer and this product. The average house that we're probably looking at sells for $190,000. So once again, now in your neck of the woods, $190,000 house isn't very nice, but in Indianapolis, it's a pretty nice house,
I
right?
don't even know if there is a house for 190,000 where
Yeah,
I
but
live.
once again, you've dealt in those other markets, so
Yeah.
you know,
Mhm.
and we start out with we buy notes on good properties. Like that's a given. I've my life experience, and I've had a lot of it in doing this, is people that live in a good property and have some equity that becomes their home, and they have then what we call the most important part, Kathy, which is emotional equity.
Yeah.
That's their home. And I like buying that paper. And I own the first mortgage on somebody's house. You know, I don't own their house, but I'm the bank. I'm collecting interest every month. I'm collecting a payment every month. I'm the first to get paid every month, not like the landlord who's the last to get paid, so to speak, right? Landlord gets paid after everybody else gets their money, right? And so I like doing that. And it does pretty well because the yield on notes today is, you know, call it 9 to 11%,
Yeah.
right?
It's incredible.
The yield on a rent house today, this is before you pay the bank, but after pay all the expenses, taxes and insurance and the plumber and the carpet and all that, that tends to be not so good today, 4% range, something like that. So a lot of people like this,
Yeah,
it's
but
not
you have
quite
to
the
have
same.
money, right? Because it's great for a, let's say, self-directed IRA. Lending is fabulous and note buying, but this isn't for somebody just starting out, right? You have to have money to be able to buy that note, or is there another thing I don't know about?
Yeah. So one of the things that we're really good at teaching is leveraging techniques,
Hmm.
right? See, Kathy, I bought 50,000 notes.
Yeah, I know. It's
Right.
like, how did I know you didn't have, I don't know, but perhaps you didn't have all the money yourself in your bank account to do those.
That's correct. I didn't have
Okay.
all the money in my bank account. And so we have developed leveraging techniques. And those leveraging techniques are what you allow to do deals, to invest in a note, then recoil and get most of your money back, and then do it again and go do it again. And so we essentially teach people these techniques. And that is a big deal when it comes to how you go do more than one deal. Because think
Hmm.
about it. How good would the rental business be if you could never get a loan on a
Yeah, if
rent
you had to
house?
pay cash for everything, right?
Yeah.
So that's what's always confusing about the note business is it's not maybe as easy to go out and get that money, but or maybe it is.
I think that's a myth.
Okay. Ah, secrets. Your lips are sealed. But yeah, I know that there's ways, there's probably banks, I'm guessing now, no credit lines. How do you do it?
Yeah, you can certainly use the institutional methods, which are banks or credit facilities, but there are a huge amount. People are sitting on more cash today than they've ever sitting on in the history of America. They're sitting on 25% more cash today than they were in the blight after 2008. Right, 2008, everybody took their money out of the stock market, and we were sitting on this crazy amount of cash. Well, now the amount of cash people are sitting on today are 25% more than that. And so it's a wild number on how many people are sitting on cash because they're trying to go figure out what to invest their money in. And some things aren't quite as clear. Like, I'm not a stock market guy. I'm not criticizing the stock market. It's just not my thing. I know what I know. And you'd say, Eddie, you've been successful enough in notes. You probably should stick with what you're good at, right? My diversity is I own a bunch of different notes, right? And I like that. But
this is important for people to hear is like, you have stuck with it. You're the note guy. You didn't veer off into apartments in 2019 when everybody else was. Maybe you did. Maybe you bought the notes for those. But so many people will see a shiny object and move on, and you've stuck with it even through the tough cycles, it seems like. And what would you say about that kind of focus?
Well, I've learned to reinvent myself. I mean, I've been doing this since 1980, 45 years, right? So, I've learned to reinvent myself. Like, what I did, 2021 was different than what I did in 2015 or in 2009. And so in different markets, you do different things. But this is a good side of the cycle. I told a private audience the other day, these are coaching students. These are people that are kind of my inner circle, most inner circle folks, right? I said, if we can't figure out how to kill it in the next 4 years in this business, we never will. The stars have aligned, and we have a tremendous opportunity to do it. And you're saying, well, Eddie, why are you so optimistic? Because one of our big focuses today is showing people how to convert a rent house to seller financing. And the math is pretty crazy. And there's 18 million rent houses. So we don't lack, like, I don't have to convince everybody with a rent house to go do this. My gosh, Kathy, if I got 500,000 people to convert their rent houses to a seller finance, and I built a machine to help them do that, and I have, then all of a sudden, I mean, that's the best thing we've ever seen. That's the best fishing I've ever been able to go fish. The best day I've ever been able to go fishing, so to speak.
Yeah, because the people renting homes would probably love to own the home if they're in a position to do so. Not everybody wants to own a home. That there's confusion about that, but somebody who maybe loves that home, wants to stay, their job is nearby, their kids are in school, they would be the perfect person to.
Probably, though, 20% of the people that we would help seller finance are the existing tenant, and 80% are somebody else.
Oh, okay.
So here's some market stats. Here's some things that like, this is why this works so well in today's market. I know that when you do an interview, you don't want to overwhelm people with stats, but sometimes the numbers matter, right? Did you know, Kathy, that people's mortgage payment is 138% higher than the rent on the same house? If you rented the house or you made a mortgage payment, the national average is people's mortgage payment is 138% higher than the same house would rent for. Now, that does include taxes and insurance, okay? But just say that it's 110%, 120% is, people's mortgage payment, just taxes and insurance. People's mortgage payment is higher than they're paying rent on the same house. Several people have written about this. John Burns has written about it. Bigger Pockets has written about it. Like, I laugh and say they've been watching Eddie Speed's podcast because they've now figured out seller finance. Because when you hear that is instantly tells me, wait a minute, it's more profitable to be the bank than it is something else today. And when I'm the bank, I don't have expenses. I don't pay people. I I'm not responsible for their taxes and insurance and paying the plumber and paying the maintenance. Like I get to keep the money. And so those are the market conditions that have kind of evolved that have made this what we might call the perfect storm.
Yeah, interesting. Okay, Eddie, I have known you long enough that, and I've done your courses. I have actually done this, but not with you, and I didn't do it right. And so I would like to kind of bring that up, that there's risk even to holding a note. It seems risky than having a rental property where maybe your tenant loses their job and now they can't pay your rent. That's difficult, but there's risks to being a note holder as well.
Yeah.
I know at the time we had several, and it was in Pennsylvania, and particularly in the Pittsburgh area. And it's pretty easy to evict somebody who's not making paying their rent, but it's very difficult to foreclose on them and to get that property back. So there are risks. We managed to do it somehow. I don't know. We were able to convert them back to a renter. So then we were able to evict them. I don't know how we were able to pull that off, but we did. But what are some of the risks that you see out there, people doing this incorrectly?
Well, I'm going to lead with a saying. And this is an old banker told me this 40 something years ago. He said, Eddie, the time to worry about a loan is before you make it.
Yes.
Right. And so I'm going to lead with that because underwriting is everything.
It's
Underwriting
everything.
is just,
And the terms of the
underwriting
loan.
is calculating the risk. What's the odds? And so we have enough experience and we've developed a lot of technology and a lot of tests around this. So we underwrite a loan today that we believe has a 3 to 5% chance of having a problem, meaning that the odds of having a problem are not impossible, but they're low. Okay. And it's simply a matter of doing everything that every smart lender should do. Does the buyer pay a down payment? Does the buyer can they prove their income? How do they pay others back? What's their credit look like? Right. Can they afford this home and do they have a habit of paying other debts back? So those are just basic underwriting concepts
That any
right?
bank would do, right?
Anybody. And just because we're seller financing doesn't mean we don't have underwriting. Like we have
And then the bank
underwriting.
also underwrites not only the borrower, but also the property, right? They want their appraisal. They
100%.
want to make sure that the value is
100%.
there. And that one thing that banks don't do that always surprises me is that they don't really look at the condition, it seems like they get an appraisal of what the current value is, but what if there's just a ton of deferred maintenance,
Well, Fannie Mae definitely has a condition classes. They have a
Okay.
very defined condition class, and we use those classes.
Okay.
So we'll do a class 3 neighborhood and a class 3 level condition house. A class 4 condition level house would be on an exception. Maybe we do it if this was wrong with it, but we wouldn't do it if that was wrong with it. And so understand, no, they have absolutely, there's very definable property conditions, and we stick to those codes. Listen, my shop, Kathy, as you well know, these are a bunch of people that come from the mortgage banking world. Like the people in my shop, you go walk around and ask them their resumes. They all came from mortgage banking shops. They all come from loan servicers. Like this is like it's just because we're doing something that's not so commonly known doesn't mean that we don't have good underwriting standards to do this. Now, point being said is what you said a while ago. Not everybody seller financing has good practices.
Mm-hmm.
And so we think of about 100,000 seller finance notes a year, about the top 20% of those notes is the notes that we think are in our target range. 80% of the notes that are seller financing, we don't think we would buy those notes. So we're very focused on that 20% who originates that loan. Where do they do it? Where do they come from? How can we serve them? And so we feel like we're in a good spot because when you look at these loans, if you went through files and looked through the property and the credit and the this and the that and stuff, and you're like, my goodness, I can't believe they didn't get a traditional loan origination. And I'm like, because it's an underserved market. That's why we're chasing this.
Good stuff. Okay, Eddie. So who's the right investor for this type of deal to be a note investor versus a landlord versus investing in a syndication? There's so many options in real estate. Who would be the perfect note investor?
In the last 2 years, the refugee from syndications has been big. So people
Hmm.
that would have invested in a syndication invest in notes. And I tell people, like, I think the note is a very good balance. Call it the perfect balance, right? With a syndication, you don't have any work, you just don't have any control,
Yeah.
right? With a note, you have control because you own the note, but you don't have the workload of being a landlord. Like, so it's
Hmm.
a good balance in between. And I tell, like, I have lots of students that we've helped convert rentals, lots of students that have taken, other money. We become an alternative to rental houses. We're not trying to beat up rental houses and say none of that works. We're not saying that in any way. But we're saying if you're looking for a diversification, notes are a better diversification than other things you could invest in, like syndications, right? And you can earn a good return. And you say, well, you said earlier I shouldn't say safe. I drove to work this morning, Kathy, and there's not 100% chance that I made it. Like, something, I could have had a wreck and
Sure.
died, right? So, but I'm saying to you that I made an acceptable choice to drive to work. I didn't have to
Yeah.
stay in a bunker, right? I just went on a family vacation a little bit while back and went on Thanksgiving and went with my family and my grandkids, which I would do anything to protect. But you see what I'm saying? There's a difference between 100% chance of nothing could ever go wrong and what I call safe,
Hmm.
right? And there's an and so I think that there's an acceptable risk and based on what you get in return. And I think the alternative is, should you have all your money in the stock market?
That's also not safe.
Probably not.
Yeah.
Probably you need some diversity. That's what the experts say. And so I think it's a good diversity, and people like being the bank. They like to be the guy that's getting interest every month versus paying interest. Some people like that. I
Yeah.
do.
Especially if you're busy professional, it is super helpful.
Yeah.
Okay, Eddie. Well, it is always a pleasure to learn from you and have you here on the Real Well Show. Thank you so much for joining me.
Thank you.
For Real Wealth members who want to go deeper into note investing and learn more about the strategies Eddie teaches, you can find additional resources at noteschool.com/real wealth. As always, thanks for joining me here on The Real Wealth Show. I'm Kathy Fettke, and we'll see you on the next episode.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.